I don't even know the legalese of that. I know how to receive cash compensation. I have no idea how to receive equity in a reliable way where I don't get swindled.
That's a perfectly reasonable point. There's a great instrument called a SAFE, which is variation on convertible debt. So the way you'd handle getting paid, especially when you're outside the context of a priced round, if the company doesn't have cash, what they can do is write a note, basically an IOU, right? I'm going to pay you a certain amount of money at some point in the future. In great likelihood, they don't actually have the cash for that, and we need to agree that we're not going to come after them for the cash for that. So instead, we're going to subordinate it to this idea they could convert that cash into equity at a certain price. So what's that price going to be? And this is where the cleverness comes in, because you can say that the price is going to be like at a 20% discount to the next round of equity that comes in. And that guarantees that, like, should they go raise money, I would make 20% of my investment, right? Because they would say, okay, well, we're going to pay you $10,000, but it's going to be $10,000 of equity, which will be priced at, on a per share basis, 20% discount to whatever we next raise at. So whenever they raise, I would get, $12,000 of the stock at that price. And by deferring the question of pricing, it makes it much simpler. So a SAFE is an instrument that was created by Y Combinator that's actually very investor friendly, because it says, yeah, you know what, the debt part, you're never, ever, ever going to see that money, which you kind of never were, even in a convertible or subordinated debt basis. You're just going to say the only way you'll ever see anything is going to be if we raise and what that price is. So a liquidity event if they're sold, or priced at the next round, at which point.
But when you say priced at the next round, do they agree to a fixed amount, the $10,000? And then, where did the $2,000 come from? There
are basically three things that they would need to agree to. The first is they would need to agree to my rate. What are they paying me, right, that I'm then forgiving?
So that's a fixed amount.
So that'd be like me writing them a check for, say, $10,000, because which would be the same thing as them hiring me for like 20 hours, right? If I have $500 an hour, 20 hours, $10,000, and they would agree there's a $10,000 bill, right? And we're going to pay it using this SAFE.
Real quick, unlike Ethereum, there's no gas limit on expressing your gratitude, so go ahead and click that like button. Thank you.
You don't see inflation of that amount based on their valuation and fundraising?
Now we get to the second part. So first we're saying there's an investment that just got made of $10,000. Now the question is, how do you exchange that investment for stock? Right? Because of course there's no price on the stock right now. So usually they would call it a discount, a haircut. And when the company has liquidity or raises the next round, you will receive stock equal to, the price of the stock, right? Or your investment divided by the price of the stock times 1.2.
Okay, and this is all written out in the SAFE?
And that's part of the SAFE.
Okay.
And then the SAFE also has what's called a cap, or usually sets a cap or a floor. And if we raise, that's terrible, the minimum valuation, if we raise and we don't raise until much, much later, and therefore the valuation of the company is really high, which means that your $10,000 isn't worth very much, right? You can imagine this is incentivizing them to put off their raise, right? We can just say that we cap our risk on that by saying that the maximum price that would have to pay for the stock would be like a pre-money of 5 million, right? So if they raise later at a pre-money of 10 million, well, I'm actually gonna get 2x. So this allows everyone to sort of put together a deal that feels fair without having to put exact pricing on the company.
Right, and the incentives are fairly well aligned.
Yeah. Fairly well aligned, yeah. I mean, basically, the founders could always just walk away from the company and then don't have anything. Of course, they don't have anything either at that point.
Exactly.
But they would have the benefit of my advice. And for me, part of the benefit is just getting to do more of those relationships, because I get to learn a lot. And these are interesting people to work with.
Yeah, for sure. And it's a small world, so.
It's a small world. I get to do more like the Polkadot. I was involved in Polkadot Hackathon. And because we did so well at the Internet Computer Hackathon, and I was, invited to present at their demo days and whatever, I just didn't have the time. Basically, it took away half the window we had allocated for working on Polkadot. I got to learn a whole bunch about Polkadot, and Polkadot is really interesting and complicated, but we just didn't have time to build with it. So I basically put it down in favor of getting ready for HackFS and Buildle, which are the next two hackathons that I'm doing with my teammate, which are due on the 24th and the August 1st. My point about Polkadot thing and working with those startups is that by working with Polkadot, I have learned a tremendous amount about how to think about blockchains, about what a blockchain can really do, about how to think about authorization and authentication and delegation of responsibilities, and how to think think about how information teleports when you're going across chains. These are all ideas that Gavin Wood and his team over at Parity have been working on that are really interesting, and I'm now much more thoughtful about these than I was, and I'm already bringing them to bear. So being able to work with interesting, complicated companies gives me context I can use to bring to bear for other clients or other circumstances as well.
As always, if you want to stay apprised of the latest around emerging tech, then go ahead and hit that subscribe button. Thanks.